Welcome to this explainer, where we're going to dive right into the data and uncover a really complex structural disconnect that's hiding just beneath silver's current price tag. Look, we've got a seriously fascinating analysis to walk through today. We're pulling straight from recent market data that shows what looks like a totally calm market on the surface, but might actually be one of the most intense financial pressure points we've seen in years. So let's just get right into the numbers.
Okay, so right now, silver is sitting pretty calmly right around that $76 mark. If you're just glancing at the ticker, it looks like just another average day in the markets. But according to the deep dive analysis we're unpacking today, this surface number is basically an illusion. It's masking a really turbulent reality. Because underneath that $76 price tag, the real physical market, like the actual bars and coins you can hold in your hand, is showing undeniable signs of a fresh structural breakdown.
To understand exactly why that $76 level is so deceptive, we really have to look at the recent timeline. Think about it. Just earlier this year, in January 2026, silver hit this massive peak of over $121 an ounce. Fast forward a few short months to May 21st, and it closed all the way down at $75.46. We're talking about a dramatic drop here. So, the totally natural question this raises is, are we just looking at a standard market correction, or is something structural fundamentally breaking down under the weight of this huge swing?
To answer that, let's look at the structural deficit we're facing. Literally, 6 straight years of shortfalls.
To truly understand this price behavior, we've got to look at the physical foundation. And that all starts with just relentless industrial demand. You see the run-up to $121? That wasn't driven by Reddit retail traders or wild speculation. No, it was driven by the structural reality of modern tech. Every single solar panel needs silver paste to collect electricity. Every EV relies on silver for its wiring. 5G antennas, advanced semiconductors, and those massive AI data centers being built everywhere right now, all of them chew through actual physical silver. This industrial demand honestly doesn't care about market sentiment. It just literally needs the physical metal to function.
So the crucial takeaway here is that this relentless demand has ripped open a massive, persistent gap in the market. Since 2021, we've run a cumulative shortfall of roughly 820 million ounces. Let that sink in for a second. We have consumed 820 million more ounces than we've actually mined. And the hole's only getting deeper. The 2026 projected deficit alone is over 46 million ounces. And meanwhile, global mine output actually dropped by about 2% recently, even with these historically high prices. Why? Well, because you can't just flip a switch and magically pull more silver out of the dirt. It takes years to build a new mine. Supply simply cannot keep up.
Which brings us to a massive disconnect in the market: paper versus physical.
If supply is incredibly tight and demand is surging, you're probably wondering, why isn't the price absolutely skyrocketing right now? Well, analysts point out that silver basically lives a double life. It operates in two parallel realities. On one side, you have the digital paper market, your futures contracts, ETFs, digital claims that institutions trade at lightning speed. On the other side, you've got the physical silver market, the actual heavy metal sitting in vaults in London, New York, and Shanghai. And right now, these two markets are telling completely different stories.
The ratio between these two worlds is honestly staggering. On the COMEX exchange, which is pretty much the main price setter in the West, analysts estimate there are roughly 400 paper contracts written for every single ounce of real, deliverable silver. 400 to 1. That is wild. The paper market is essentially operating as this giant multiplier balanced on top of a base of physical metal that is rapidly shrinking.
There's a really brilliant analogy from the source material that hits the nail on the head. Think of it kind of like a grocery store, where the label on the shelf says milk is $2 a gallon. But when you check the back room, there are literally only 3 gallons left for the whole store, and every restaurant in town is fighting over them. The paper price is the shelf label, but the physical market is the back room. And right now, that back room is nearly empty. The price on the shelf simply hasn't realized that the inventory is gone.
And now we hit the accelerants: vault drains and global hoarding.
See, for years, that 400 to 1 paper multiplier worked totally fine, mostly because traders just settled in cash. But lately, physical buyers are demanding the actual delivery, and the data shows severe physical drains accelerating everywhere. During that January 26 squeeze, the COMEX saw withdrawals of over 33 million ounces in just 1 week. Over in London, freely circulating supply dropped to an estimated 130 million ounces. But the craziest figure? In Shanghai, inventories have plummeted by roughly 90% from their 2021 peak. The physical metal is just vanishing from exchanges.
This mass exodus of metal is causing absolute panic on the physical side. As those vaults drained in January, the cost of borrow physical silver for short-term delivery in London spiked to a massive 30% lease rate. To put that into perspective, if you know your market history, we haven't seen lease rates hit that level since the Hunt brothers famously tried to corner the silver market way back in 1980. That 30% number is basically a blaring siren warning us about extreme physical scarcity.
Adding even more pressure to these draining vaults, major global superpowers are actively locking down their own supplies. China, which used to be a net seller of silver to the world, has officially classified it as a strategic material. They've tightened export licenses and started hoarding physical silver at a national level. At the same time, the U.S. officially designated silver as a critical mineral in 2025. Look, when the biggest economies in the world start hoarding a commodity and restricting exports, it completely rewrites the availability equation for everybody else.
So let's unpack this price drop. It really comes down to mechanical selling versus physical reality.
Because we have to address the elephant in the room. With historic shortages in superpowers hoarding supply, why on earth did the price crash back to $76? Well, it's pure market mechanics, not a change in physical supply and demand. First, as the US dollar got stronger, the COMEX increased margin requirements. When that happens, highly leveraged traders get margin calls and are forced to immediately sell their paper positions regardless of what the metal is actually worth. Second, geopolitical tensions cause traders to panic and liquidate commodity positions just to hold cash. This forced, mechanical selling absolutely tanked the paper price, even though the physical shortage in the background didn't change one bit.
Which leads us directly to the breaking point, the physical premium detachment.
Because while the paper price was mechanically dropping on the digital exchanges, the physical retail market started telling a totally different story. If you actually go out right now to buy real physical silver, you are not paying that $76 spot price you see on your screen, not even close. Physical dealers are currently charging around $85 to $86 for the real thing. Normally, in a healthy market, the physical premium you pay above spot is maybe 3 to 5%. Today, you're looking at premiums of 12 to 14% above spot. This huge gap is a massive warning sign. The paper price and the real price are actively divorcing from each other.
And the institutional analysts and producers tracking this stuff, they see this tension plain as day. The current spot price might sit at $76, but JP Morgan's global research team forecasted silver to average $81 in 2026, and that was before the January spike was even fully baked into their data. Even more telling, the actual silver producers and royalty companies are using internal valuations of $122 an ounce. The people actually digging this stuff out of the ground are valuing it way, way higher than the paper market is.
So as we wrap up, we are left with one critical question. As that empty physical backroom violently collides with the artificial $76 paper shelf price, which side of this historic structural divide is finally going to surrender to reality? Can a paper market running 400 to 1 leverage seriously continue to suppress a physical market that is structurally completely out of supply? Are we witnessing the quiet breaking point of the global silver trade right now? It's a pressure point that absolutely cannot hold forever. Thanks so much for joining me on this explainer, and as always, keep questioning those surface numbers.